If you're looking for ways to maximize your tax return, you've come to the right place. In this video, I'll be sharing 10 ways to maximize your tax return, and I'll even be sharing some exciting news that you may not know about. Just remember that this video is general advice only and not personal financial advice. If you'd like personal financial advice or personal tax advice, it's important to speak with a professional. You can read my full financial services guide in the description. So generally speaking, when it comes to taxes, the things that you buy that can help you produce an income are generally tax deductible. And the things that you buy that don't help you produce an income generally aren't tax deductible. Let me give you an example. I'm a content creator and I create content for a living. So I bought this microphone, which helps me create content and also helps make my content better. Because purchasing this microphone is related to my job and also related to helping me earn an income, this microphone will probably be tax deductible. But for example, if I was a personal trainer and I bought this exact same microphone, it may not be tax deductible in that situation, because if I was a personal trainer, then buying a microphone wouldn't really help me earn an income. Obviously, this is a very general and simplistic way to look at taxes, and there are exclusions and special conditions which do apply. So that's why it's so important to get your own personalized tax advice. So the first tip is to claim all of your tax deductions. 1 year is a really long time, and it can be really difficult to remember all of the things that you purchased for work, which could be tax deductible. But I've created a tool which can actually help you keep track of your tax deductible expenses. So let's say, for example, I want to tag this microphone expense as tax deductible. I simply put in tax deductible, and now I've created my tax deductible tag, and I can actually tag some of these other expenses as tax deductible. And then I can actually filter by these tax deductible expenses, export them as a CSV, and then send them off to my accountant. And if you're wondering what this tool is called, it's called Billroo, and it's a budgeting and personal finance tool. And if you'd like to try it out for yourself, you can check out the link in my description below, so you can try it for free to manage your budgeting and personal finances. I still do run all of these expenses by my accountant just to double check if I can actually claim them. The second point is to make sure that you are claiming an immediate tax deduction for work purchases for $300 or less. If you use the item over 50% for work and it costs $300 or less, you can actually claim an immediate tax deduction, but the purchase must also satisfy these 4 tests. The first one is the purchase costs $300 or less. Test 2 is you use it more than 50% of the time to produce an income that isn't a business. Test 3 is the asset is not part of a set costing more than $300. And test 4, it's not part of a group of identical or substantially identical items. So let's say, for example, you purchase a handbag for work for $300, and this handbag you solely use for work. It fits your laptop and all of your work things inside. You can write off the entire cost of the handbag in the year that you bought it. So if your marginal tax rate is 32.5%, that's a tax saving of $97.50. So that means you're effectively getting a $300 handbag for $202.50 because of the tax saving. But let's say instead of that handbag costing $300, that handbag costs $500. Since it is over that $300 threshold, you won't be able to claim an immediate tax deduction. Instead, you'll have to depreciate that $500 purchase over a few years, so the tax saving is dragged out. The third tip is to utilize the First Home Super Saver Scheme if you haven't bought your first home yet. This is honestly something that I wish I knew about earlier when I was saving for my first home. So let's say you earn $80,000 per year and you salary sacrifice $12,000 per year with the First Home Super Saver Scheme. That means after 5 years, you would have saved $50,732, which is over $13,000 more than if you saved in a high interest savings account. And here's why. You essentially get to save on tax because super is only taxed at 15%, whereas most of our marginal tax rates are above 30%. And then when you withdraw these extra salary sacrifice contributions, you get a tax offset of 30%. Just remember that there are limits that do apply to this scheme, and you can only withdraw your extra salary sacrifice contributions. You can't withdraw any of your mandatory employer contributions. This is a really cool scheme, and I honestly wish I knew about it earlier. This next point goes hand in hand with the First Home Super Saver Scheme, and that is salary sacrificing. Salary sacrificing is essentially an agreement between you and your employer, where you agree to receive less income before tax in exchange for other benefits. It really depends on where you work and the kinds of benefits that you can salary sacrifice. You can salary sacrifice things such as superannuation and cars. But depending on where you work, you may be able to salary package or salary sacrifice a few other things like your rent or mortgage payments, insurances, travel expenses, etc. One of my friends works for New South Wales Health, and she's actually able to salary package quite a lot of things with New South Wales Health. So it's worth chatting to your employer to see what you can do. But keep in mind, your employer may need to pay an extra tax called fringe benefits tax in order to provide these benefits to you. So you may need to reimburse your employer slightly for these extra benefits. So you kind of need to weigh it up to see if it's right for you. And if you're enjoying this video so far, don't forget to give this video a like and subscribe to this YouTube channel. The next point is to consider private health insurance for hospital cover if you earn above $97,000 for singles or $194,000 for families if we're looking at the 2024 to 2025 thresholds. So for context, all Australian taxpayers do pay a Medicare levy of 2%, but the Medicare levy surcharge is an extra tax that they do place on higher income earners in order to try and get more people to take out private health insurance so that these higher income earners don't place as much pressure on the public health system, especially the public hospital system. It could be worth it for you if you are above these thresholds, or it might not make sense, so it's up to you on whether you think private health insurance is worth it or not. The next point is to make sure that you are utilizing your 50% capital gains tax discount when you do hold your assets for longer than a year. So let's say, for example, you purchase some shares or ETFs, and then 16 months later, you sell these shares or ETFs and you make a $10,000 profit and you have no capital losses. Since you held on to your investments for longer than a year, you are entitled to a 50% capital gains tax discount. So in your tax return, you declare a capital gain of $5,000 instead of $10,000. This is one of the ways that the tax office does like to incentivize long-term investors. The next point is to make sure you are claiming interest on a loan for an investment. So let's say, for example, you take out a loan with the bank to purchase an investment property, or you take out a loan from the bank to invest in shares. Since the loan is used for an investment, this is generally tax deductible. But if this loan wasn't used for an investment, and let's say you took out a loan to purchase a home that you live in for your family, the interest that you pay on this loan generally isn't tax deductible. And this is because the ATO looks at what the loan is being used for. If it's used for investment purposes, it's generally tax deductible, but if it's used for private purposes, then it generally isn't tax deductible. But there actually is a way that you can make the home that you live in tax deductible through a strategy called debt recycling. So let's say, for example, you have a $500,000 mortgage and $100,000 in cash. You can use that $100,000 to repay your home loan. So then you'll have a $400,000 mortgage and $100,000 worth of equity. You can then choose to withdraw that $100,000 worth of equity and use it to invest in shares. This means that the $100,000 worth of equity that you have withdrawn from your home loan to invest in shares is tax deductible, but the $400,000 mortgage that you have on your home loan isn't tax deductible. And as you can see from this ATO article, the ATO looks at what the money is being used for. If you're using the redraw amount to produce an accessible income, the interest proportion of that loan is deductible, but any amount of that loan that's used for personal use is not tax deductible. So if your mortgage interest rate is 6% and your marginal tax rate is 32.5%, that's a tax saving of $1,950. You can then use these tax savings to repay your home loan and use the dividends that you receive on your $100,000 share portfolio to repay your home loan faster. So before you implement it, it's a good idea to get advice from a tax accountant or a financial advisor, or both. So the next point is to look into getting an EV if you're a business owner or an employee with a novated lease. And the reason why is because there's actually a fringe benefits tax exemption on EVs. And this basically means that, let's say for example, your employer gives you a car. You generally do need to log the amount of times that you use that car for work use and the times that you use that car for personal use. And then based on these numbers, you generally do need to reimburse your employer, because your employer will need to pay something called fringe benefits tax on them providing this work vehicle to you. But since EVs are exempt from fringe benefits tax, that means you can essentially claim 100% of an EV as work use, and you or your employer won't need to pay any of this fringe benefits tax. There are terms and conditions and exclusions that do apply to the scheme, so it's important to do your own research. You may even be able to claim courses and study expenses. If you enroll in a course that's related to your current job and it helps you increase your income in your current role, then this course could be tax deductible. But you may not be able to claim a deduction on courses if it doesn't have a significant connection to your employment activities at the time, or if it enables you to change roles completely. For example, if you're moving from being a nurse to a doctor. You can also claim a deduction for the cost of managing your tax affairs. So for example, if you have a tax accountant, you'll be able to claim a deduction for your tax accountant's fees. There's no limit on the amount of money that you can claim for accounting fees per person. So for example, if you spend $5,000, you can claim the whole amount. And you can even claim the travel costs of going to see your tax accountant. Potentially even the debit card fees or the credit card fees that you pay when you do pay your tax accountant, plus many other expenses related to tax advice. And if you have any journals or software that helps you manage your taxes, you may be able to claim a deduction on those as well. And similar to getting tax advice, if you do decide to hire a financial planner or a financial advisor, you may be able to claim a tax deduction on those fees as well. Bonus tip, and the tip that you've been waiting for: from July 1st, 2024, all taxpayers will be getting a tax cut. And here are the new tax rates and thresholds from July 1st, 2024. The 19% tax rate will be reducing to 16%. And this tax rate, which went from $45,001 to $120,000, will actually be increasing to $135,000. And this rate will be reduced from 32.5% to 30%. This tax band has increased to $35,001 to $190,000 and will be at 37%, and the top marginal tax rate of 45% will be increasing from $80,000 to $190,000. These new tax rates and thresholds mean that all taxpayers will be getting a tax cut. So if you earn $100,000, that's a tax cut of $2,179. And by the way, if you would like to try out a tool to help you manage your personal finances and your tax deductible expenses, don't forget to check out Bilru in the description below. And write us a comment below with the word safe in it, just so we know you watched this video all the way through. Thank you. Bye.